Today, household finances are shot. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I want to take you through the results of our December 2018 Household Financial Confidence Index surveys, which follow on from the mortgage stress data that we released yesterday. Now, the overall index fell in December to an all-time low of 87.3, which is a bit strange given the government's assertion that the economy is in fine fettle. And 87.3 is as low as the index has been since we've been running it for more than 6 years. And by way of background, these results are derived from our household surveys averaged across Australia. We have 52,000 households in our sample at any one time. We include detailed questions covering various aspects of a household's financial footprint. The index measures how households are feeling about their financial health. To calculate the index, we ask questions which cover a number of different dimensions. We start by asking households how confident they're feeling about their job security, whether their real income has risen or fallen in the past year, their view on their cost of living over the same period, whether they have increased their loans and other outstanding debts, including credit cards, and whether they are saving more than last year. And finally, we ask about their overall change in net worth over the past 12 months. And by net worth, we mean assets less outstanding debts. Now, the DFA index can be segmented a number of different ways to home in on which households are most concerned about the state of their finances. A significant factor is whether households are property owning and whether they are mortgaged. Households who hold property but no mortgage are the most confident and above the 100 neutral setting, although confidence in this group is falling. And those with mortgages are well below the neutral measure, and confidence in this group continues to fall. And those in the rental sector or living with friends or family are less confident, though recent wage rises and falling rents have had a slightly positive impact this month. Now, another way to look at the data is via property segmentation. And within the property holding segments, we can separate property investors from owner-occupied households. And significantly, property investors have gone very negative now, thanks to falling property prices, rising mortgage costs, and issues with mortgage refinancing. And the threats to negative gearing are also in play, and concerns about rising mortgage rates are also building. For example, yesterday the Bank of Queensland moved their mortgage rates 18 basis points higher in response to higher funding costs. And we expect to see more banks lifting rates in the weeks ahead. We've been signalling this for some little time. This is because the bank bill swap rate is significantly higher. Owner-occupied property holders are more positive. Those with mortgages and those mortgage-free are both within this segment. And property inactive households, those with no exposure to property, are slightly more confident now than property investors, which is an amazing turnaround. We can also examine the data across the main states. And when we do, we find a bunching of scores now as New South Wales and Victoria come off their highs. And of course, the main centres of gravity in terms of price falls are in these two states. Southern Australian households have remained more positive, while Victorian households have taken something of a dive as prices are moving south at a faster clip. Finally, we can look across our age bands. And here, younger households remain the least confident, and the general slide continues across the various age bands other than those aged 50 to 60, who are less likely to hold mortgages, and so are more likely to reside in the free affluent segment. But now we can move to look at the data drivers behind the index. So first, turning to job security, we see a spike in those feeling less secure, up 3%. And workers in the construction and real estate sectors have become more concerned. There was a fall of 1.7% in those feeling more secure than a year ago at 11%, and 53% of households reported no change compared with a year ago, which is down 2%. Looking at savings, we see that they are taking a beating, with more households tapping into savings to sustain their budgets. And they're also being hit by falls in interest rates on deposits and falls in volatility in the share markets. 2% only are more comfortable than a year ago, 46% are less comfortable, and 51% about the same. Now, debt remains a major source of concern for many households. Whilst overall personal credit, other than for mortgages, is falling, there are credit hotspots where households under pressure are putting more on credit cards, using staged repayment products like Afterpay, or even payday loans. And many households are finding their large mortgages more difficult to handle, as reflected in our stress report that we spoke about yesterday. Around 1.5% of households are feeling more comfortable than a year ago, 46% less comfortable, and 51% about the same. Now turning to household income, incomes do remain under pressure, with many reporting no increase in real incomes in the past 5 years. Many households are working multiple jobs and are still underemployed. In addition, the interest on deposits held with the banks have fallen significantly as the banks trim their interest rates to protect their margins. So 4% of households said that their income in real terms had risen over the past year, 53% said it had fallen, and 43% said there was no change. But a lot of the issues are created for households around the cost of living. Households reported continued rising living costs in December, with an additional 1.5%, or a total of 86%, saying costs in real terms had risen. 5% said they'd fallen, and 8% said there'd been no change. As well as the usual suspects, higher electricity bills, healthcare, childcare, and some food costs, a number of households reported rises in land taxes as a concern. And once again, the official CPI seems disconnected from the true experiences of many households. Costs do continue to rise, and fast. Finally, to round out our discussion, we look at net worth. Assets less loans owing. We see a rise in those reporting a fall, directly associated with the fall in house prices. 34% said their net worth had dropped in the past year, 33% said it had improved, and 29% said it was about the same. So whilst for some the wealth effect is intact, 1/3 are feeling the effects of a reduction in wealth on paper, and as a result they are more cautious on their planned spending. This is sufficient to slow consumption ahead and may well impact GDP as a result. So in summary, we see households' financial confidence continuing to be eroded, with costs of living rising, with financial pressures increasing, particularly relating to mortgage rates, and with home prices now driving wealth significantly lower. As a result of that, we do expect households to hunker down more, and therefore we would expect consumption to continue to slide. We should expect weaker retail sales figures ahead, and a lower contribution from household consumption into the next set of GDP numbers. Now, there will be a small spike around Christmas, but of course a lot of that Christmas spending was supported on credit, so we will expect to see the credit being repaid in the next 3 or 4 months. That will have a downward impact in its own right. In summary then, in the months ahead, we expect to continue to see these trends playing out, with costs of living continue to rise, with mortgage rates potentially rising even if the Reserve Bank does choose to cut later in the year, and with net worth being eroded by home price movements. In particular, the housing sector is having a negative impact on the overall economy, and in particularly on household wealth. This is unlikely to change anytime soon, so we expect household financial confidence to continue to drift lower, and we will update the index again next month. And one last point before I go. I have now scheduled our next live stream event for Tuesday, the 15th of January at 8 p.m. Sydney time. As normal, we'll be discussing the latest data on finance and property, and also taking live questions through the chat. But if you'd like to send me questions beforehand, please do so either by using the YouTube or the DFA website. I look forward to seeing you next week and having another interesting conversation about the latest events as they happen. If you found this useful, please do like the post, add a comment or a question. I do read them all. And if you haven't subscribed, please do so by ringing the subscribe bell. And if you'd like to support our work, please consider contributing via Patreon, here's a link, or making one-off contribution via PayPal. Your support is really essential to enable us to continue to make great content. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.